Welcome to the channel, and thank you for joining me today. Retirement is one of the biggest financial goals we'll ever prepare for. And whether you're just beginning your investment journey or you're already close to retirement, one thing is certain: you need a balance of growth, stability, and reliable income. That's where dividend ETFs come in. In this video, we're going to break down 5 powerful dividend ETFs that can help you build a retirement-ready portfolio. Each one brings something unique to the table, whether it's growth potential, consistency, or income, and together, they can form a foundation for long-term financial success. The 5 ETFs will cover are QQQI, SCHD, CGDG, LVHI, and DIVO. By the end of this video, you'll understand how they work, what their strengths are, and how they might fit into your retirement plan. So, let's get started. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. When you think about retirement investing, you want 2 things. First, you want your money to grow so you don't outlive your savings. Second, you want consistent income so you can cover your expenses without constantly worrying about the stock market's ups and downs. Dividend ETFs are powerful because they do both. They spread your money across dozens or even hundreds of companies, lowering risk compared to individual stocks. They pay you dividends regularly, often quarterly or even monthly, giving you a steady stream of cash. And many dividend-focused ETFs are built around companies that are financially strong and stable. That combination, growth, income, and stability, makes dividend ETFs one of the smartest ways to prepare for retirement. Now let's walk through the 5 ETFs I want to highlight. The first ETF on our list is QQQI, the NASDAQ 100 Income ETF. This fund is perfect for anyone who loves the innovation of tech companies but wishes they provided more consistent income. Here's how QQQI works. It tracks the NASDAQ 100, which includes giants like Apple, Microsoft, and Nvidia, but it adds something extra: a covered call strategy. That means the fund sells options on its holdings, generating income from option premiums. Combined with dividends, this creates reliable monthly payouts for investors. For retirees, this is incredibly valuable. Tech stocks are known for growth but not necessarily for paying dividends. QQQI solves that by turning tech exposure into an income stream. Of course, there's a trade-off. Because of the covered call strategy, your upside growth potential is capped. If the NASDAQ 100 soars, QQQI won't rise as much as QQQ. But in exchange, you get more consistent cash flow, which for retirement investors is often more important than chasing maximum gains. If you're looking for a way to capture the power of big tech while still enjoying dependable income, QQQI deserves serious consideration. Next up is SCHD, the Schwab US Dividend Equity ETF, which has become a household name for dividend investors. SCHD focuses on high-quality US companies that not only pay dividends but also have strong balance sheets, steady earnings, and a history of increasing their dividends over time. This ETF typically yields around 3 to 4%, which is a healthy level of income while still leaving plenty of room for growth. Its holdings include companies like Coca-Cola, Pepsi, Merck, and Texas Instruments, names you probably recognize, and companies that have been rewarding shareholders for decades. The advantages of SCHD are clear: it has a strong long-term performance record, a rock-bottom expense ratio, and a focus on both quality and consistency. The downside is that its yield isn't the highest out there. But in exchange, you're getting reliability, growth, and stability. For many retirement investors, SCHD is the cornerstone of their portfolio. If you want a fund you can buy, hold, and rely on for decades, SCHD is an excellent choice. Our third ETF is CGDG, the Capital Group Global Dividend Growers ETF. Retirement is not just about investing in US companies. Adding global diversification can strengthen your portfolio and reduce risk. CGDG invests in companies around the world that have a strong track record of dividend growth. That means you're not just getting exposure to dividend-paying companies, but companies committed to increasing those dividends over time. The benefit here is diversification. You get access to markets and sectors outside of the US, which can be especially important when the American market faces challenges. However, investing globally does bring risks, such as currency fluctuations and higher expenses compared to US-only funds. For a retirement-ready portfolio, CGDG helps ensure you're not putting all your eggs in one basket. It's a smart way to capture growth and income from a global perspective. The fourth ETF is LVHI, the Legg Mason Low Volatility High Dividend ETF. This fund is designed specifically for investors who want high dividends but don't want to deal with extreme market swings. LVHI focuses on companies that pay strong dividends while also maintaining lower volatility. That means the companies in this fund tend to have more predictable earnings and steadier stock prices, which helps protect your portfolio during downturns. The yield is generally higher than what you'd get from something like SCHD, making it appealing for retirees who prioritize income. The trade-off is that it may not grow as fast as broader market ETFs. Still, the stability and higher yield make LVHI a great choice for risk-averse investors who value peace of mind. If sleeping well at night is part of your retirement plan, LVHI deserves a place in your portfolio. The fifth ETF on our list is DIVO, the Amplify CWP Enhanced Dividend Income ETF. What makes DIVO different is that it's actively managed. Instead of just following an index, professional managers select blue-chip dividend stocks and enhance income by selling covered calls. Its holdings include familiar names like Microsoft, Johnson & Johnson, and JP Morgan Chase. The fund pays dividends monthly, which is very attractive for retirees who rely on consistent cash flow. The advantages are strong monthly income, a solid performance track record, and active management that can adapt to changing market conditions. The downsides are a higher expense ratio compared to index funds and limited upside because of the covered call strategy. For retirement investors who like the idea of monthly income and professional oversight, DIVO is a great addition to consider. Now that we've covered the 5 ETFs, let's talk about how they work together in a retirement portfolio. QQQI gives you exposure to technology with an income twist. SCHD is your foundation for stability and growth. CGDG brings in global diversification. LVHI balances things out with low volatility and high yield. And DIVO offers monthly income with active management. Together, these ETFs cover all the bases: growth, stability, and income. How you allocate them depends on your personal risk tolerance and retirement goals. A conservative investor may want more weight in LVHI and DIVO, while someone seeking more growth may lean heavier into SCHD and QQQI. The key is building a balance that works for your needs. Preparing for retirement doesn't have to feel overwhelming. With the right mix of dividend ETFs, you can create a portfolio that pays you regularly, grows steadily, and provides stability through market ups and downs. The 5 funds we've explored today, QQQI, SCHD, CGDG, LVHI, and DIVO, each bring something different to the table. Used together, they can form a retirement-ready strategy designed to support you for years to come. So, which of these ETFs would you add to your portfolio? Let me know in the comments below. And if you found this video helpful, be sure to like, subscribe, and hit the notification bell so you never miss an update on dividend investing and retirement strategies. Thank you for watching, and here's to building a retirement that's truly ready, stable, rewarding, and built for peace of mind.